All right, our next guest is Mr. Sean Huang. Sean is the co-founder of First Beijing and the portfolio manager of First Beijing First China Fund. Earlier in his career, Sean worked closely with large multinational food companies as the director of international sales at his family's food processing business in China. And he holds an MA in finance from Peking University's Huanghua School of Management in Beijing and a BS in finance and accounting from the New York University Stern School of Business. Please welcome Mr. Sean Huang. Sean, good to have you.
Sorry. Hi.
There you are.
Can you see me?
Much better. Yes.
Right. Okay, great. Thank you. So if you just give me a minute and I'll just share my screen.
While you set that up, Sean, we're just going to post up the poll for your topic, which has to do with the ADR delistings. The U.S. will remain as a popular listing venue for China Inc. Agree or disagree? This will be interesting to see how consensus is in the topic you have today. Sean, you have 8 minutes. The floor is yours.
Okay, just 1 second.
Sean, you've turned off your camera there.
Okay, is it better now?
Yes, much better. And we do see your presentation.
Okay, great. Yep. So thank you for having me. My name is Sean Huang, and I'm the portfolio manager for the First Beijing First China Fund. So just a little bit about ourselves before we start. We are a China-based investment company that is based in China. Our focus is on finding good companies in China that are undervalued. We have a research team of roughly 30 research analysts that are based mostly in China, in Shenzhen and Shanghai. And we are singularly focused on studying and following the best companies in China. So we usually focus on companies that we believe to be misunderstood or under research, and then buying them when their prices are selling at a big discount to what we believe they're worth. So one of the areas that we're currently finding opportunities is the US listed Chinese companies known as the Chinese ADR. So I'm very surprised by the level of sophistication of the audience that we have here today. So I think that I will go a little bit quicker than what I have prepared. But just to give everybody a very quick background on the Chinese ADRs. So Chinese ADRs are a group of Chinese companies that are listed on the US stock market. And I think, in my personal view, they are some of the most market-driven, innovative, and technologically advanced companies in China. And these companies have chosen to list on the US instead of on the domestic Chinese capital market for a number of reasons. But I think primarily because most of them were invested by international investment organizations. I think these organizations prefer to exit through the overseas capital markets. In comparison, domestic capital markets have a more rigid listing requirement, such as minimum profit requirements, very strict share placement approval process. And, many of them would need to wait in queue in order to be listed. So I just want to highlight that for the most part, these Chinese ADRs represent the best businesses in China. Most of them are audited by the Big Four. They have good corporate governance for the most part, with very respectable board members. And you can see in the chart here, over the past 10, 20 years, they have created tremendous shareholder value for their shareholders, more so than their counterparts that are listed on the domestic stock exchange or also on the Hong Kong. So if I could just speak briefly about this uniqueness of the offshore Chinese equity market, this ADR. Basically, you have Chinese companies that are listed on a Western stock exchange that are primarily priced by investors who are foreigners. So domestic investors in China, on the other hand, they are predominantly blocked from investing in the ADR because their capital cannot exit China. So this mismatch between companies and the investor base creates inefficiencies. So prices of these companies are easily influenced by sentiment and headline news towards China. So when the market is feeling positive about China, prices of these Chinese ADRs can shoot up, vice versa. When the market is feeling worried about China, their prices can be very depressed. So the size of the Chinese ADR market has grown quite a bit over the years in terms of both companies and the value of market capitalization. There's approximately 250 companies with a market capitalization of $1.5 trillion. And a year ago, the total market capitalization was twice as that. So it's a fairly large market. For the most part, as I've mentioned, these Chinese ADRs include some of the best companies in China, and I think all over the world. But I think that there are some shortcomings. For example, most of these companies are structured as VIEs, which means that investors own the holding company that indirectly own or control the businesses that are in China. And also, it's difficult for the US regulators to have complete control over the management of these companies. So in the past, there have been a number of companies that have been dishonest in inflating their financial statements. So this is why we think that there has been periods where the whole sector was sold off. So for example, in 2012, short seller firms like Muddy Waters started publishing short seller reports attacking the accuracy of the financials of many of these Chinese ADRs. While there were certainly many ADRs that were fabricating their financial statements, many were also good companies. But I think at that time, the market discarded almost all of them. So that created very good opportunities to buy. Stocks that were targeted dropped 50%, 60%. But within a year, the prices of those fundamentally strong companies have recovered within most of their value. And within 2-3 years' time, many of them have appreciated many folds. Another example happened in 2015 when many of the Chinese ADRs decided to privatize themselves and return home to the Chinese domestic market. And when the A-share market bursted in 2015, that caused many of the ADRs to renege on their privatization proposal. This also casted many ADRs in bad light and reduced the valuation for the entire group. And there are other examples, such as in 2018, when the government, very similar to 2021, enacted policies that were viewed as anti-business. And also in 2020, when the billion-dollar company Luckin Coffee was found to be fabricating a statement. So all of these, including what has happened in 2021, have created drawdown, but I can also think opportunities to be buying the fundamentally strong companies. So if we look back on all these events, I think these would have been great buying opportunities. So I know that we are pressed for time, so just to quickly go over the key topic for today, which is ADR. So I think that in December 2020, this act, HFCAA, was formally passed, which gave SEC the ability to delist companies whose auditors did not grant access. So other negative events, such as the Russian-Ukraine war, have gave reason for the market to really sell down on these Chinese ADRs. While the threat of delisting is a serious one, we believe that there are multiple ways that this issue gets resolved. Firstly, since January 2022, there has been many positive, productive discussions between the regulators of both countries. We list them here, but we won't go into details for the sake of time. And secondly, many of these companies listed as ADRs are actually dual listed on both the US and as well as Hong Kong, which means that in the worst case that these Chinese ADRs are delisted, the companies will be able to continue to trade on the Hong Kong Stock Exchange and be accessible to international investors. Of the ones that have not dual listed, there are clear guidelines for how to dual list. And last but not least, many people worry about the liquidity and the ability for US investors to invest if companies delist from the US and relist on Hong Kong. Firstly, there isn't any clear directives or rules that would restrict US or Western institutions from investing in Hong Kong listed companies. And we at First Beijing, we work with a number of global institutions and sovereign wealth funds that are based in the US and also around the world. We do think that there is still very positive about investing in China. Secondly, we believe that making Hong Kong the primary place of listing actually enhances the valuation of these Chinese companies rather than depresses it. This is because if a company is listed on Hong Kong or has Hong Kong as this primary place of listing, it can actually be included in the pool of stocks that can be purchased by domestic capital via the Stock Connect. This means that domestic capital, which understand these companies better, usually are willing to pay or price these companies at a high valuation. We have seen strong evidence showing that Hong Kong listed technology companies trade at a significant premium to their counterparts that are listed on the US or are dual listed. So I think we view the current ADR delisting issue as a non-fundamental issue. While in the short term, it could cause some short-term turbulence. But, we see that there are many ways that these issues could be worked out. And I think that it serves as a good opportunity to invest in the greatest companies in China at a big discount. So therefore, First Beijing, we continue our laser focus on businesses with strong fundamentals and that are consolidating markets during this economic slowdown, but will reemerge as stronger companies. So I will stop here and then answer any questions.
Right. Thank you, Sean. That was very good. And I think it's a nice pump for Hong Kong, much needed during these times here, as we're still seem to be, well, we're not locked up, but we can't quite go to as much as we want to. So just to bring up the poll we had earlier, the US will remain as a popular listing venue for China Inc. Looks like we're 61% disagree, 39% agree. Daniel, I'll leave it up to you. You have the floor.
Yeah, thanks, Sean. Thanks, Alvin. Yeah, I'm more than happy to see that people are quite positive of Hong Kong taking over the baton, so to speak, if these companies have to delist from the States. But one common argument or concern that most of the people have is that, in fact, a lot of these US listed ADRs, they are actually held by passive investors or actually ETFs, which obviously a lot of them, if these companies are delisted and even if they relist in Hong Kong, they may not be able to be assessing, let's say, these companies or even be investing in them. And then the entire unwinding process and moving over may cause quite a bit of volatility in the market. How do you see this panning out? And have you been doing more research, as in saying to what extent, in fact, are these US ADRs are held in the hands of the passive investors?
Sure. So I think it's a good question. It's not necessarily a question that we at First Beijing are concerned with, because we focus on the fundamentals. So I think that there could be volatility, but we see volatility as an opportunity to buy the companies that we really want to partner with in the long term at a cheaper price. But just to give some angles, I believe that the shifting has already happened and it has been accelerating. So I think that if you look at many of these dual listed companies, you can track actually what percentage of their shares are now in Hong Kong versus in the US. So I think you can see that for the most part, the percentage that are in Hong Kong have been going up and it has been accelerating from the beginning of 2022. So I think that's a positive. And I think if you look at some of these more well-known ETFs, such as the K-Web, they have announced that since the beginning of the year, they have been in the process of converting these ADRs in Hong Kong. So I think that these things are not important to us in the long run. I think in the short run, it is in the process of happening. So I don't expect this to be a very, very significant event where most of these passive investors will wait till the end of the potential delisting process to make the conversion or to sell out. So I think this will be a very gradual process over time.
Thank you. You showed on a chart earlier that you're quite confident that every time when there is a shock in the ADR market, somehow the market will come back to sensors and trade back to, let's say, historical average. Now, we all know that the US listed sort of Chinese companies were quite tech heavy. And we also know what actually happened, let's say a year ago, when the big techs, and in fact, all those companies that used to have very high profit margin and growth were under very heavy scrutiny by the government in the name of common prosperity and whatnot. So this probably is not as much as just an ADR question, but how do you see that going into the future? Maybe we will just never see that kind of high profit margin that we have once been sort of enjoying will ever come back to these companies. And hence that in terms of valuation or even in terms of the recovery, we won't be able to go back to the level that we have seen in the past, especially for these tech companies. What's your view on that?
Sure. So I think that's certainly the common perception, but I would actually argue something that is completely opposite, which is that the policies would actually help the profitability of these big tech companies. So I think that there are two camps. So there are companies that are currently undergoing slowdowns by the real economy, and this slowdown has caused the margins to decline. So I think this is certainly true in certain companies. For example, for the largest e-commerce company in China, their margin has been going down. But I think this is largely due to competition, not so much from the government, but it's really due to competition and the fact that they are losing market share to their competitors. On the other hand, I actually feel that the policies that have taken by the government, this antitrust policies are actually helping profitability, and will actually help profitability in the long run. This is because for many of these companies, their goal in the past was always to expand, keep expanding into new territory. And the way that they expand is through low pricing, subsidizing going into ride sharing, subsidizing going into e-commerce, subsidizing going into community group purchases. And these subsidies actually drag down their profitability. Basically, what the government is saying, we don't want predatory subsidies. We don't want excessive competition. We don't want an internet company to be able to lay in every single category, every single sub-industry. So I think what this is doing is actually making these internet companies care more about their profitability. So what you actually see is a significant reduction in the headcount of all of these companies. So I think that, yes, right now, many of these companies are affected by the slowdown. But I think that once we come out of the slowdown, you will actually see the efficiency and the profitability of most of these internet companies improving and not declining. Now, I think the problem that you will face is not a problem of margins or profitability, but a problem of growth, which is how will many of these companies be able to grow going forward because the online penetration is already so high. So I think here we are looking actually at companies that may or may not be reaching their full potential in terms of profitability, because we actually don't worry about this improvement in profitability. Rather, we want to look for companies that can still grow. So I think that's probably an example of us focusing on the fundamentals versus, I think, a majority of investors focusing on the headlines.
Okay, last question for me to sort of put it all together. From the perspective of a fund manager that can actually invest cross-border like yourself, does it really matter whether the company that you're investing in is actually listed in the States versus it's listed in Hong Kong or in the mainland, or that there is a particular reason that you prefer to invest in a company that is actually listed in the States? What's your perspective on that?
Yeah, so we are exchange agnostic. So we go where the opportunity is. First, we go where the best companies are. So I think that's the number one guiding principle. And just out of these best companies, we look for companies that are misunderstood and undervalued. And I think that different markets, depending on the macro backdrop, will present different opportunities. So I think that's where we go. So it really doesn't matter where the company is listed. Now, different markets trade differently. So I think that this will take time. And I think that over the years, we have accumulated some knowledge and understanding on how these different exchanges trade, what kind of characteristics, where they're likely to make mistakes. So I think that's the knowledge that we have accumulated. But really, to us, it really doesn't matter where the company is listed.
Thank you, Sean. Yep. I think that's all from me on this panel. Thank you very much, Sean, for giving us your perspective about the topic of ADR delisting. And just to sort of round up today's session, I think today is a very good sort of case of some of the managers on our platform, especially when it comes to their deep knowledge about specific investment issues in China. And so thank you very much for participating today. And then I pass the time to Alvin to round it up.
Yeah, Daniel, I'm pretty excited, actually. Like I mentioned earlier, CSI, HSI, the only green candles in a sea of red. And I could be that we're lagging. I'm sure we are. Everyone's very excited about what's going to happen tonight between the EC and the Fed. But the truth be told, China's been oversold for a very, very long time across all fronts. It feels almost as though the market is saying, well, you know what? How much further can we go? And when you're looking at forward PEs of like less than 10, which I can't remember the last time I saw that, it's pretty tasty, at least on the equity side. And I think Leo's discussion about high yield bonds, actually, you know what? If you have a 2 to 3 year or even a 2 year or even an 18-month outlook, looking very, very attractive. So yeah, geopolitical risk aside, I'm cautiously optimistic. What about you, Dan?
Yeah, I mean, look, somebody mentioned it the other day, like maybe after this little rebound that we've been seeing, China is actually outperforming quite a lot of markets year to date. It was just quite a surprise to me. I just sort of picked that up at the beginning of this week. My pick always on China is that I'm always more concerned when people are very bullish about China, but, never really worried when the majority of people are actually very, very bearish, because like throughout my career, that's always the best time for people to actually act on it.
Is Giovanni still online? If Giovanni's still online, love to hear his final thoughts.
Yes, I'm trying to enable my video, but you may have to do with my videos coming. Yes, I have to say, very informative. All three talks were very informative, especially on some key issues for international investors. I think the ADRs is an elephant in the room. There's a very significant amount of capital, both locally and in the US, posted on, especially ETFs, that are ADR based. And there's a fair amount of movement, but also there's a fair amount of uncertainty in terms of what to do with it. And clearly, the bond situation, onshore, offshore, the property situation is one that's sometimes a bit difficult to understand from outside, looking from outside in. And
you guys look at
and ESG is in Europe, as Marco was mentioning, a really big issue in the terms that he described. Sometimes people can be really seeing it black and white. So I think he was very enlightening to understand that ESG means different things in different places, and how the common prosperity theme fits into it. I thought it was generally very interesting.
Well, look, I think we're all you get contrarian in a way. At least it looks like even the whole region is contrary. Thank you so much, gentlemen, for joining us today. And coming from the perspective of allocators, both in Europe and here in Asia, I think it's going to be some interesting times and some tougher decisions for our European friends and even our US allocator friends on where they need to put their money in the coming 6 to 12 months. I'll close up with that. Thank you, everyone, and have a good night. We'll talk to you soon.
Thank you.
Thank you.